In the late 1920s, America believed it had found the secret to endless prosperity. Factories were humming, cities were booming, and new millionaires were being minted almost overnight. The newspapers declared it a new era, a time when economic downturns were supposedly a thing of the past. People weren't just optimistic. They were convinced the system had finally become bulletproof. But history tells a very different story. Because right before the 1929 crash, the U.S. economy wasn't showing signs of collapse. It was celebrating. And that's precisely what made the warning signs so dangerous. The most unsettling truth about financial disasters is this: they rarely arrive when fear is high. They arrive when confidence is unquestioned. In the years leading up to 1929, America was riding a wave of incredible industrial growth. Mass production was revolutionizing everything from automobiles to household appliances. Credit was easy to get, and advertising was everywhere. For the very first time, everyday Americans were encouraged not just to work and save, but to borrow and invest. The stock market became a national obsession. People who had never owned a single share before were suddenly trading on margin, borrowing money to buy stocks they believed could only go up. And everyone, from the banks to the brokers to the newspapers, was reinforcing the exact same idea. This time is different. The old rules no longer apply. This belief quietly changed how people behaved. Instead of asking if prices made any logical sense, investors were only asking how quickly they could get in. Instead of studying a company's financial health, they just followed the momentum. Speculation didn't feel reckless anymore. It felt like the responsible thing to do. But beneath the surface, the whole system was becoming incredibly fragile. Yes, corporate profits were growing, but not nearly as fast as their stock prices. Wages for workers weren't keeping up with how much they were producing. Wealth was concentrating heavily at the very top. And more people were buying things with credit, not with the money they actually earned. The economy looked strong, but it was being stretched to its absolute limit. One of the clearest warning signs was how normal it became to use leverage. Buying stocks with borrowed money wasn't seen as risky. It was marketed as a smart move. Brokers required very little money up front. This meant that even a small dip in prices could completely wipe out an investor's entire savings, yet few people even considered that possibility. The constantly rising market had trained everyone to ignore the potential for losses. At the same time, banks were deeply tangled in all this speculation. Depositors' money, the money people put in for safekeeping, was flowing straight into the market, often indirectly. There were almost no rules or safeguards separating regular savings from risky investments. This meant that if public confidence ever broke, the consequences wouldn't just stay in the stock market. They would spread everywhere. Another major signal wasn't a number on a spreadsheet. It was psychological. Public figures, from respected economists to government officials, started making absolute claims. They spoke openly about a new era of permanent prosperity. The very idea that markets could seriously fall was dismissed as outdated thinking. Anyone who expressed doubt was labeled a pessimist. History shows us that when skepticism becomes socially unacceptable, risk has already reached its peak. By early 1929, the market started to get shaky. Prices no longer rose in a smooth, straight line. There were small corrections that briefly shook confidence, but these dips were quickly framed as great buying opportunities. Each time the market recovered, it just reinforced the belief that the system could fix itself. What people didn't realize was that confidence itself had become the system. When the markets finally turned for good, the shift was sudden and brutal. Selling started to accelerate. Margin calls forced people to sell their stocks to pay back their loans. Falling prices triggered more selling, which caused prices to fall even faster. What had felt so stable and secure just weeks before unraveled with astonishing speed. The crash wasn't caused by a single event. It was the result of years of accumulated imbalance finally meeting a moment of psychological reversal. But the most devastating impact didn't come from the stock market alone. As stock prices collapsed, banks started to fail. Credit, the lifeblood of the economy, completely vanished. Businesses shut down, unemployment skyrocketed. The entire financial system froze because trust, the invisible glue holding it all together, had disappeared. The economy didn't just slow down. It broke. What makes the story of 1929 so important isn't just its massive scale. It's the pattern it reveals. The warning signs weren't hidden in some secret report. They were out in the open, but they were ignored because they didn't fit the popular story of endless growth. Growth had become the national identity. Optimism had become the official policy. And being cautious had simply become unfashionable. This is why studying the period before the crash is arguably more important than studying the crash itself. Markets don't collapse because people are pessimistic. They collapse because risk becomes invisible during the good times. The ultimate lesson of 1929 isn't that investing is dangerous. It's that any system built on too much leverage, unchecked confidence, and a belief that this time is different will eventually have to face reality, and that correction is often violent. And this pattern didn't end in the 1930s. It has appeared again and again in different forms over the decades. The details change, but the core psychology remains the same: overconfidence, excessive leverage, investing based on a good story instead of good numbers, dismissing risks simply because things have been going well recently. Understanding 1929 isn't about trying to predict the exact date of the next collapse. It's about learning to recognize the environment that makes collapses possible. The people who managed to protect their wealth during that era weren't prophets. They were disciplined. They avoided extreme debt. They questioned the popular certainty. And they understood a fundamental truth: stability that has no room for error isn't really stability at all. History doesn't repeat itself exactly, but its lessons are remarkably consistent. When optimism becomes absolute and risk feels like a thing of the past, the system is already under strain. This is a legacy of money where history explains what markets try to hide. Thanks for watching, and don't forget to subscribe for more stories like this.